move on to the first panel discussion of the day, titled New Challenges, New Answers, Understanding Mutual Funds. It's my pleasure to invite on the dais, first, the moderator of this panel, Mr. Nagarajan Narasimhan, Senior Director and Business Head, CRISIL Research. Sir, could you kindly come up on stage? Our panel members are Mr. Leo Puri, Managing Director, UTI Asset Management. Mr. Nilesh Shah, Managing Director, Kotak Mahindra Asset Management. Welcome, sir. And Mr. Nimesh Shah, Managing Director and CEO, ICICI Prudential Asset Management. I now hand over the floor to Mr. Nagarajan Narasimhan. Thank you.
Hello. Hello. Am I audible? Hi. Good morning, and thank you, AT, for this opportunity on this wonderful day. Let me invite the panelists for this discussion. We have a very eminent set of panelists, and given the topic, I think we'll learn a lot from them. Before we start the discussion, I just thought I'll share a few facts. I think all of you will be largely aware, but nevertheless, to set the context, for an industry which is nearly 3 decades old, I think we have come a long way. As of the last month, we are the industry assets under management are close to 15 lakh crore, and that's almost a 3-time jump over the last decade. Which is a fantastic achievement. And in between, we had multiple crises, the 2008 crisis, the 2011 European crisis. And despite that, and despite the domestic challenges that we saw in the early part of this decade, we have overcome most of those challenges. And if you look at the last 2 years and look at the inflows, which have been steady, I think it's a good start or a good place to be in. Within this, again, if you look at the performance of the funds, again, CRISIL, AMFI, if you look at the equity index, that's sort of significantly outperformed. Fantastic returns in the high teens as compared to even the Nifty's return over the last decade of around about 12 to 14%. So investors have really benefited over the last decade by reposing their faith and actual money in mutual funds. The industry has also really blossomed. I think the profit pools have sort of grown, I think almost tripled over the last 3 years, or last 10 years, almost 3 times. So it's a nice, good place to be in if one were to look at that way. But if you look at on the other side, there are challenges or opportunities, whichever way you want to look at it. One is, if you look at the overall mutual fund industry's penetration, the total AUMs, while it is fairly large, at 200 odd billion, it is like 10% of the overall GDP. And if you were to look at some of the developed markets, that would be significantly higher, like US and all would be close to 80-90%. So there's still a long way to go in terms of the potential for this industry. Again, within this, if you look at where the investment is coming from, it's largely still concentrated in the top 15 cities. That would account again for 80-90%, if not more, of the entire industry's AUM. The so-called beyond top 15 or B15 is still a completely uncharted territory, or there's still a lot of leeway for growth in the cities and towns beyond the top 15 cities. If you look at again in the composition of the entire industry, debt funds actually account for almost 2/3, and equity would be for the balance 1/3. Globally, if you see, equity is a much larger share. If you look at, again, US probably could be 60% or slightly higher, and debt would be much lower. So both these segments have a huge potential to grow, equity as well as debt. And we would want to discuss something about that, given the way the bond markets are opening up, what are the opportunities for the debt funds, and similarly on the equity side also. Again, if you look at the way the industry structure is changing, distributors account for 2/3, and direct sales is almost a third of the entire way the funds actually flow in. Again, this segment is seeing a lot of change over the last few years. Technology is coming up in a big way, and we want to understand from the panelists, how do they see that changing the industry? And lastly, again, the industry itself is getting fairly concentrated. Even though there are more than 3 dozen players, the top 5 or top 10 account for almost 80-90% of the entire industry AUM. So while the industry has grown over the last decade fairly well, the opportunity is fairly huge. At least as per CRISIL's estimates, the overall AUM could be more than 35 trillion over the next 4 years, both driven by the growth in the asset, underlying asset, as well as the fresh inflows. So that's a huge potential. And how do we tap that potential? So in that context, I would want to start off the discussion and listen to the speaker, the panelists' views on how do they see the entire industry growing? Do they see the current trends continue? Do they actually see accelerations in the entire growth prospects? Or do they see some impediments that they see along the way? Or just to paraphrase Mr. Nandan Nilekani, what he said about in the banking sector, applying that to mutual fund industry, do we see a WhatsApp moment in the mutual fund industry over the next few years? So with that, I just wanted to start off the discussion, let each of the panelists to share their initial thoughts, and then we could get into a discussion. Sir.
Thank you. Well, good morning to all of you, and thank you to all of you for having us here as well. So I think many of us are probably quite influenced by the fact the last couple of years have been very good, and with all the macro underlying changes that have taken place, positive government, I think we'd all agree that we are indeed feeling fairly optimistic and quite upbeat about our industry. And if you peel back some of that sentiment, there is a fairly strong foundation actually to support it. Some of this, I think, has been well documented, which relates to the shift that is happening from physical assets to financial assets. That's a long-term trend. There's very clear evidence it is accelerating, whether it's gold or it's real estate. You can see the migration into not just fixed deposits, as used to be the case, but increasingly into capital market products and insurance as well, for that matter. And the ULIPs revival is another signal of that. I think that's very positive. The second is the continuing development and depth in our capital markets. And you can see this in the way bond markets are being promoted now, as you mentioned. You can see this in the revival of the primary market, which is a very good lead indicator, actually, of the health of markets. More than just secondary market activity, it's when the primary market starts to revive that you really feel a little more confident as an investment firm that the good times might be here to stay. And we've seen some very successful primary issuances here. We've also seen and talked a lot about the demographic shifts that are happening. India will have both the largest number of young people and the largest number of retired people very soon. I think by 2030, we will be in the top category in both of those, which is a somewhat interesting situation, actually, for a country, but very, very interesting for a capital allocation intermediary like the mutual fund industry, because you have, on the one hand, young people looking to save and build wealth for short to medium horizons, and then you have the retired people who are needing to draw down on products that they have already accumulated wealth. So between retiral and the need to, create wealth for a young, aspiring middle class and youth, tremendous pressure, I think, and opportunity to create the right products. So all in all, very strong foundation. Where are the 2 or 3 areas which I think could help us address this quicker? One, I think we have to ask ourselves why we have got stuck at a fairly low level of penetration. And I think the answer lies around 3 dimensions, which I'm sure I won't go into it too much to allow my colleagues also to explore these. But we know that there's still poor awareness and understanding of the products that we offer, because we are not seen as offering a guaranteed product or an assured product. There's a perception of complexity in our product. 2, there are operational issues which we have not been able to fully overcome. And again, a perception that unlike dealing with a bank, it is somehow much more complex to enter this product, to exit this product, to get information, KYC. These are real barriers for the retail investor. And the third is we still have a broad and complex set of regulatory issues which create the perception that the playing field is not yet level. And I think I'll just leave it at that and say the challenge remains, therefore, that we have still not really penetrated this segment. We have grown, but we have grown along with as opposed to ahead of the market. We've grown along with the pie. We have not succeeded in expanding the pie. The next big leap must be to expand that pie.
Great, sir. Nilesh, would you want to add on and your thoughts on?
Sure. Very good morning to all of you. As Leo mentioned, we have laid very strong foundation for mutual fund. In terms of performance, Indian mutual funds are next to no one. If Warren Buffett was equity fund manager employed in Indian mutual fund, he would have lost his jobs couple of times. So that's the performance we have delivered. Today we have 1.1 crore SIPs bringing 3,500 crore flows. It allows mutual fund to stand in front of FII, and that's real matured money coming in. We have now about 15 lakh crore plus AUM. As you mentioned, it's less compared to the developed world, but within the circumstances, it's reasonable. Globally also, mutual fund industry don't take off on day one. They all have their J-curve hockey stick. I think our time is coming, our hockey stick is coming. And legitimately, we can take pride in saying that, okay, we have made mutual fund rich here. But again, the future is far more promising than what we have achieved in the past. Today, we have about 5 crore folios, and assuming that there are 5 folios per customer, we probably have 1 crore unique customers. The potential is 25 crore plus. So we have just penetrated 4-5% of our potential, and that's the opportunity which is lying in front. Will mutual fund alone will be able to achieve that potential? Of course not. It requires support from regulators. It requires support from media. It requires support from our side, efforts from our side. And most importantly, it also requires support from the distribution community as well as investors. If all of us work together, will mutual fund industry in India one day be as big as what US mutual fund is? I think the answer is quite likely yes.
Thank you, Nilesh. Nimish, you want to share some thoughts?
See, my basic belief is that the way the mutual fund product is constructed, the way regulations have come up, where were we in 2008 when the crisis hit us, a global crisis hit us, and where we are today? I think it is one of the very well-regulated industry. In terms of US is still thinking whether to give a negative return or not. I'm saying that we are so well-regulated that there were 2 days in 2013 where interest rates went up and liquid fund gave negative returns, and the audience was mature, the customers were mature enough to accept it, and there was absolutely no repercussions in the market. So I think it's a very well-regulated product, and every rupee in mutual fund I think is working for the benefit of the final investor. The product is so transparent that because of the transparency in the cost structure, in the where money is invested, if you give me 100 rupees today, you exactly know where that money has been invested by the end of the month. So that is the kind of transparency, and the full amount gets invested. So vis-a-vis any other product in the financial services industry, it is one of the most transparent product, and it is good for the customer. We feel very good as heads of companies also that we are doing a good job for nation building. I think this industry is required to grow very fast if we want capital formation to happen in the country very fast. And you help the retail investor to beat inflation. I think from the customer point of view, from the nation point of view, I think this industry is doing a fantastic job today. As both of my colleagues have mentioned, we have got miles to go, and it is only I see more and more opportunities. There are challenges in terms of if you want every customer to be a mutual fund investor, are we making it easy for him to enter the industry? One biggest change that is required, which the regulator also agrees with us, is that how do we make the onboarding process of taking a mutual fund easy? If somebody comes on my site or if somebody wants to invest in the mutual fund, if we make the onboarding process, if government helps in making the onboarding process easy, I'm referring to the KYC thing, then this one single change can multiply the number of investors within one single year. I'm not talking about multiple years. If you want to invest the number, if you want to increase the number of investment, we need to simplify our KYC and the market will zoom up. In terms of the number of people who will come into the mutual fund industry is mind-boggling. Today we are making it very difficult. We try our best that the guy does not come in. It's as difficult as that, the whole KYC process. So the product is good, the customer needs it, the nation needs it. We need some small changes here and there, and then the market, I believe the number of investors in this industry will grow manifold.
Thanks, Nimish. I think broadly some 2 or 3 themes that the panelists are sort of brought out. One is this entire aspect of awareness levels, the product complexity, and how do we go about. Second is the aspect of operational issues where both of them talk about how do we make onboarding far more easier, and the regulatory aspects, and how do we get all the other stakeholders to participate in this journey. So let's start off here with each one of it. Sir, you talked about product awareness being low. At the same time, the regulator has been sort of focusing on investor education in a big way. There is 2 basis points of the AUM which goes into the kitty for investor education, and the industry has sort of moved significantly from where we were, say, many years back in terms of moving the needle on the investor education, both at a broader level and at going to each of these markets, micro markets, and through various fora and various forms of media. Given that, do you think enough is done? What else needs to be done? How do we scale this up? In every aspect of life, we are talking about massive scaling. If you look at the electronic world, Facebooks and Googles go to millions and billions of users within a few months or years. How do we sort of leverage on technology or any other aspect to scale this entire process of investor awareness? How does one really know that we have reached out to the last mile? What are the opportunities? What are the challenges that you see, sir?
Yeah, actually, a lot of work, as you know, has been done on investor awareness, both at a fund house level and now at an AMFI level. And when you talk about investor education, there's a difference between awareness/familiarity and knowledge.
True.
I think generally, if I'm honest, I'd say we've done a reasonable job as an industry at promoting familiarity and awareness. Knowledge is a more complex issue if we were really to probe ourselves. And, you know, I think at the end of the day, knowledge of a financial product, indeed of most things, most soft skills, is acquired through experience and use. If you look at the development of financial awareness and knowledge in Western societies, developed societies, it has happened either through a product like 401k, which is an auto-enrollment product, where people started to experience a product. When you experience a product, you acquire knowledge. Suddenly, even whether you're an elderly lady or a middle-aged, blue-collar worker, you're looking at statements, you're comparing it with your friends or your neighbors or your colleagues. You start to discuss this. You say, is my plan doing better than your plan? So this is a bit of a chicken and egg problem. If you really want financial awareness, you need to first solve the problem told them, or indeed the good books that Nilesh has written on investing, and which are all very useful, provided you have already got some experience of the product. Then you build on these other factors. So I think if we're going to have a revolution in investor knowledge, we must solve this problem of participation and enrollment. And there are ways to do that. I think the retirement opportunity is a very big opportunity. The universal KYC, universal Aadhaar-based e-KYC will allow us to explode in terms of offering products that are properly tailored for segments who are already this 90 crore, bank account segment, and we can respond to that. So that, to my mind, will be the best answer to this problem of awareness. And of course, we are proud, however, of everything else that we're doing, but we know that will not be enough on its own.
Interesting, sir. I think, like you said, user experience is the best way to sort of entice. Yeah. And typically, most of us would start investing by learning from what our friends or somebody in the family is actually experienced.
Right.
And I think that's a good example. But the other fact is also the knowledge levels, the imparting of knowledge at, say, a fora in like a curriculum at college level, school levels. Would that be another way to get to the audience, which will probably potentially get into the sort of earning population and sort of make them aware? Today we have a lot of focus on the past, but not on the future. If you look at the school curriculum or college curriculum, is that the way, another option to look at?
Yeah, it is very important. So you must do those things. But as they say, field and forum. You need to be in a forum where you are taught things. You need to be in the field to experience it. So as with all life skills, any life skill, you need to be doing both. And I think our challenge as an industry is we create this familiarity and awareness, but there's still a lack of experience. So we don't get what I feel could be the real bang for the buck from in a way, some of the investments we're making. But it'll happen, I hope.
So Nimesh, what's your experience been? I think as one of the largest fund houses, you would have traversed a journey and must have experimented a lot in the field of investor education. So what's been your experiences like?
I think the awareness level today is very high because of the various initiatives, and this for one reason I'll speak good things about the media. I think the media has done a fantastic job. If you see any of the regional newspapers also today, there is a personal finance column. So I don't think awareness is a huge issue, and because even when a yoga teacher says like yoga is like SIP, yoga is like SIP. When we advertise today, we don't have to talk about what is SIP. We state says SIP. So SIP has become a household name, and awareness is not an issue. The products are structured in such a way that I would say when people worry about mis-selling, I feel that the products mutual fund is structured in such a way that it is not capable of mis-selling. So let it be sold first, right? That's what my worry is. It's so well constructed product that if somebody, and with the equity markets the way they are in India, in a growing country like India, as long as people stay in a mutual fund product for a longer period of time. So what are we doing as mutual fund? What we are trying to do, or you also asked what is the WhatsApp moment in mutual funds. I feel this whole concept of giving minimum negative experiences to customers, right? As long as customer, first as Mr. Leopuri said, customer has to experience it. And then how do we, because the truth of the Indian markets is that we are a volatile market. And another uncomfortable truth is customers are not comfortable with volatility. So the product has to be volatile. Equity markets have to be volatile, but the final customer does not want so much volatility. How do we construct products that are not as volatile as the markets are? Can we do that? And I think that WhatsApp moment, that what you are talking about, or something I compared to the Indian banking industry, the way ATMs change Indian banking industry, I feel that dynamic asset allocation kind of products, where you swing between debt and equity, reduces the volatility for the customer, which is essentially is looking at. And we believe that the number of negative experiences that we give to customers will be relatively lesser if we are more and more into those kind of products. I feel the Indian customer is not looking at making 30% per annum. If you give him something more than bank fixed deposit in a tax-free manner, he's very happy with that. So if we create those kind of products which reduce the volatility from his experience, so those are the kind of products which will build more confidence. And as Mr. Puri said, he will experience it more. When he experiences it more, he will come in again and again and again.
I think that's a very valid point, Nimesh. I think, and relating to what Mr. Puri also said is, the more initial experiences are positive, the greater the confidence, and that's like a virtuous cycle. The other point that Nimesh initially mentioned was about the operational issues. And today we are talking, despite all this, mutual funds probably account for less than 5% of the household or retail sort of wealth. Whereas if you look at the other asset classes, say gold or real estate, are people are far more comfortable, probably far less regulated. So for asset managers like you will have to compete in an environment where the traditional asset classes are there, very well established, whereas this industry would have a lot of other sort of regulations and as well as procedural sort of issues. One of the things was about universal KYC. So what are the things that one could do both from the industry side, also from the regulatory aspects? What needs to change to ensure that there is a level playing field, things become far more easier, simpler for people to invest in mutual funds?
So as a country, we have to take a call. What is good for us? Is it good for us if, like in gold, you can walk into any jeweler's shop, pay cash, and walk with the gold? You can't do that in mutual fund. You can't buy mutual fund by paying cash. Today, there are many jewelry shops where if you purchase gold in certain quantum, you have to give permanent account number. And where do they source their permanent account number? Many a times they go to railway station and pick up from those reservation chart, name of the person and PAN number, and offer it to their customers. Now, there are many jewelry shops where if you go and buy a gold coin, and if it's in smaller denomination, you're probably down by between 30 to 40%. The jewelers make that kind of money on selling gold coins. On the jewelry, 18 karat jewelry, 22 karat jewelry can be sold as 24 karat jewelry. Marking charges, there's no control over it. Now you have created an empire where cash is permitted, quality control not necessary. You can invest as much black money as you want. There's no KYC required. And you can charge as much as you want to your customers. Now, if you are going to give this facility to gold business, is there any surprise that we have far more number of gold investors than mutual fund investors? Now, look at the real estate, which is one other segment where people have deployed large amount of their savings. Most of the time when you buy real estate, do you know what is the carpet area, what is the built-up area, what is the super built-up area? Is there any control on the builder at what time he will deliver? In mutual funds case, we have to publish NAV at 8 o'clock every day. Can you imagine a builder delivering his premises on time ever? You go to a builder and the galleries and balconies and all kinds of things are part of the room. I mean, where is the regulation in real estate? If there is a nala flowing in, it can be shown as a river. The photoshopping is an acceptable practice in real estate. In mutual fund, if I want to tell that, look, I have made someone's money double in 2 years, I'm not allowed to say that. I have to say that I have only made 20% per annum compounded return. What is more sellable to people, double your money or 20% per annum compounded? So on one side, we have an industry where even telling the truth is constrained. And on the other side, we have industry where telling lies is encouraged officially. And then we are complaining, oh my God, in mutual fund, you are only $200 billion. The gold is $1 trillion. We have created rules and regulations to encourage investment in gold, to encourage investment in real estate. I think time has come for policymakers to take a call. What is good for India? Investing in gold, investing in real estate, or creating capital formation, as Nimesh mentioned, through capital markets. So we need to create a level playing field between gold, real estate, and mutual fund, and bank deposits, and insurance, and then see what happens.
I think it's a fair point in terms of, I think you've touched a chord with the audience. I think that's something that everybody relates to, Nilesh. So picking on from Nimesh's point about sort of focusing on ensuring a minimum negative expectations or experiences for the retail investor, and one of the examples he talked about having a dynamic bond allocation, asset allocation fund. From the industry's point of view, sir, if you see a huge number of products, innovation has been one of the key aspects. But when you look at the retail audience, and if you want to enhance the penetration levels, is innovation, more newer products is the way to go, or for the initial stage of development, at least have simple, easy to understand products to get the people and, like you talked about, get the initial experiences and then sort of grow on that. What is the way, or probably both of them have to coexist?
Yeah, I think the job of our industry is to create products for all segments.
Sure.
So in a way, this debate around too many or too few products is a little off base in my view, because function is which segments are you serving with which products. So as you say, for retail customers coming on board, the ability to invest in either a balanced fund or a large cap diversified fund and a low risk duration fund. So these products actually already exist. We don't, in a way, need to create them. We have created well-constructed balanced funds, asset allocation funds, capital protection schemes. So we have a number of products which are well suited to that investor. But it's also our job to create abilities for investors to take more or less correlated risk in a way, if they want to. When they come to us, we should be able to provide them products which will be a little contrarian to where the mainstream of the market is going. And as you get more and more sophisticated customer segments, they expect and demand those products. If we don't provide them, they might go to less regulated parts of the economy to get those returns, which could range from anything to, a plantation scheme to something else. So it is better, as Nilesh said, to come within the tent of a well-regulated infrastructure and be able to provide these products, provided they are clearly positioned. Some people will say, well, a sector fund or a concentrated fund is a bad thing per se. That's obviously not correct. It is not a bad thing per se. It is a good thing to have as part of a portfolio for an investor who is performing an asset allocation exercise, either because he's a sophisticated self-directed investor or because he's working with a trustworthy advisor or distributor who's helping him construct. And it plays an essential role in his portfolio construction. So we need to have those products. So I feel that debate has been, I think, a little off base, if I may say so. I don't think it's a helpful debate because we have already created that. And I think what is appropriate is to say the role of the advisor, distributor, intermediary, whatever you may, however you may describe it in these days, that language is itself being debated. But, there needs to be somebody who essentially is a counselor and a guide to investors when they come on board and as they go through the journey of investing. That is an essential component of developing a healthy mutual fund industry. They are the ones who are best suited to help filter out for particular customers. And this is a situational issue. It's not an absolute answer that is correct in all situations. In each situation, there is a good answer for a family, for a trust, for an individual, for a retired person, for an army officer, whoever. And these intermediaries are the ones who have to craft and construct those strategies for them. Our job is to give them the tools to do that. And I think that's what we should be measured and evaluated on. And I think objectively, we think we're doing a good job there. We must work to strengthen that intermediary layer, not weaken it, to ensure that this task of intermediation happens well.
Sure. That's a fair point. I think in a vast market like this, I think people need various choices. And for the less initiated, probably there is a very strong role of the intermediaries, especially the advisors, IFAs, to come in and play that role. So picking on that point, Nimesh, I think also if you look at the way the trend is from a bundled sort of a distribution where the distribution is also the friendly neighborhood advisors or the last mile or the retail investor, you also are seeing the emergence of pure play advisors in this space. But India also has traditionally this practice of not wanting to pay for any research, advice or something. Is that something that you're seeing as an experience in dealing with your intermediaries, or do you see that trend growing over the future?
I think the biggest challenge for us, and which I think the industry is also executing well, are we able to move people who are only tracking past performance to people who become concept sellers or financial planners, whichever way you want to. We want people to move rather than only tracking the last 3 years' performance, because I think, frankly, that will be replaced by a robo-advisor. Because you don't need a person to tell you that last 3 years' performance has been this 1 year. So what has happened in India is traditionally the funds which have done well in the past have been sold the maximum. Now suppose today is the time. In fact, somewhere I believe it can be the other way around. If mid-cap funds have done very well, do you want your client today, say in today's context, do you want, if I am a financial advisor, do I have the wisdom to say that mid-caps have, the past performance is good, so mid-caps have done very well, so don't invest in mid-caps now. Now concept selling, what will work for the next 3 years is more important than what has worked in the last 3 years. The ability of our distribution to move from the past, tracking the past, to understanding what will work well in future is a big challenge. And that is what we are working on constantly. That can we move people to concept selling rather than past track record changes. If we do that, if they are able to do that, the distributors who are able to do that will survive for the long time because they are adding value to the client. See, we as active asset managers are required till we beat the benchmark. Right? If I beat the benchmark, then we are, in this industry has done a fantastic job of beating the benchmark in the past. So our value is because of that. Similarly, a distributor's value is in tracking what will happen in what will do well in future, rather than telling his client what has done well in the past. So this transition is what is happening right now, and I think some of our IFAs, the way they are going about their job, I think it's a brilliant way of. A lot of them are doing very well on this part of it.
Sure. I think it's interesting you talk about the need for moving from past performance to actually concept selling. On the other side, you also see an increasing share of direct plans, actually, the overall share in the pie going up. So, Nilesh, what's your experience been? Is that going to continue to increase in share, or probably you've reached a stage where the mix that you're currently having, 2/3, 1/3 is the way to go?
So, within that direct AUM, a larger portion of direct AUM is from liquid fund, which is essentially sophisticated corporate treasury, HNIs, ultra HNIs, family offices. Whereas the equity, which comes more from retail and HNI, there is hardly any direct. Now, as you correctly mentioned, we are not yet in that mental space where we are willing to pay for the advice. Now, that makes the advisory business challenging. Now, do we need advice? My guess is that today, majority of retail investors require hand-holding. They are more looking at the past and investing rather than looking at the future and investing. And obviously, you make money looking at future rather than just looking back into the past alone. So majority of retail investors will require advisory, will require hand-holding, will require that push from the distributor to get into the capital market, including mutual funds. They will require hand-holding during volatile times. So I think the direct and the distribution both will coexist. Direct will be more for sophisticated investors, the corporates, the family offices, the ultra-high net worth individuals. Distribution will be more for the retail investors, semi-HNIs. Both will coexist for a long period of time to come.
Sure. Moving on, one of the aspects, if you look at the data, is while debt in the overall pie is almost 2/3, but from a retail investor's perspective, debt is fairly still a very small component of the allocation of the retail investor. It's fairly skewed towards equity. How do you see that? Because traditionally, Indian investors are used to fixed return, the post office savings, or say the FDs, bank FDs, or various other saving schemes that one has. So people are used to sort of fixed return, and how do you break that mindset? Because as we speak, probably the corporate bond market is going to increase by leaps and bounds. If you look at what RBI has done last month, encouraging more and more corporates to come into the bond market. So there is going to be a significant increase in supply over the next few years. How ready is the buy side, the fund industry, in terms of having the right products to sort of engage the retail audience to sort of invest in these opportunities?
Actually, one of the big successes of the asset management industry has been the creation of successful fixed income products. I think this is a good point to underline, in fact. And whether you are an investor who's looking for approximating a fixed return through, let's say, a fixed maturity plan, it's not guaranteed, but you can approximate it if that's what your risk appetite is, or whether you're looking to take a view on duration. Let's say you're more sophisticated and you believe you have a view on interest rates and you want to express that view. We have duration funds. Or whether you are seeking enhanced yield through taking a little more risk by moving on the credit curve and the yield curve, the risk curve, if you like. Sure. We have products for all of this. And I think if you look at the industry's success in managing these products, it has been quite remarkable. It has been one of the big growth drivers for the industry over the last decade, in fact, where, of course, the sophistication the industry has now developed in terms of understanding how to construct credit portfolios has grown remarkably. And there's a lot of in-house expertise that has been developed around this, and very successful products have been launched. This is helpful to the development of bond markets that mutual funds and insurance companies participate. Duration views, again, a tremendous amount of research goes. It's essentially macro research around monetary policy direction and so on. And material investments have been made, actually, by the asset management community in understanding these trends. And in general, we have delivered pretty sound views. And if you look at the experience of this current cycle, I think many of our investors have benefited enormously with, I would say, pick up on yield relative to fixed deposit that could range from 3 to 5%, not trivial, not just 50 basis points or 1%. So I think we should celebrate the development of that segment of the market. I think it has been a material event. I think it is going to be a long-term part of the story of the industry. And we're investing heavily in building these skills, and we're doing it in a way that is in parallel with the development of bond markets in India. So I think we must be thoughtful about how we now manage and regulate and strike the right balance in the development of this, because it is a critical component, actually, of the capital formation process that Nilesh talked about. It's a critical component of creating portfolios for retail investors, which will give them balance as they look at their own asset allocation.
Yeah, like Mr. Puri talked about, I think there are, being sophisticated investors, I think the ability to go across the credit spectrum and being able to invest. On the other side, a lot of these corporates could come to the bond market with support from the banks in terms of partial guarantee and all. So what are your thoughts, Nimish, on this in terms of how this entire fixed income space for the retail segment will likely to grow, and what is being done, what needs to be done?
This is what the market wants, but I feel in mutual funds we need to be very, very, very careful. On the risk management side, I think mutual fund is all about risk management as much, and that importance. I'll just give an example. Whether Indian distributors or Indian customers understand the importance of it. When we have foreigners doing our due diligence, they meet the fund manager for 1 hour, but they meet the risk manager for almost 2 days. How are the policies? How is it going about it? What are the risk parameters? And today you have invited all fund managers, you have invited everybody, but in your conference, there is no risk manager ever. Right? I have not seen a conference where I have not seen a distributor, I have not seen a product selection committee ever questioning me on my risk management practices. I think that's a very important element, and I wish conferences like you, in addition to calling the CEOs and CIOs, or maybe call the risk managers of various AMCs, because I think that's a very important part of this whole thing. How are we managing our liquidity? How are we managing our market risk? How are we managing our credit risk? So I think regulations-wise, liquidity risk is well taken care of, the way the regulations are there in place. Even the market risk anyway is passed on, and customers are ready to accept the market risk. One thing the industry needs to be very careful of is in the credit part of it. The credit risk has to be managed well, and it has to be managed in-house. You can't, as it has been shown in the West, you can't depend on rating agencies to manage your credit. You have to manage your own credit. So the ability of mutual funds of managing that credit well is going to define the future growth in that area. That growth needs to be well calibrated. It's not that easy.
Sure. Nilesh, your thoughts?
So as Nimish mentioned, you have to manage your risk well. And there is one risk which exists in corporate bond market where mutual funds are pulling far more punches than their weight. Our size is far smaller compared to banking sector. And yet many a times in corporate bond issuances, we are the price setter rather than price taker. Our speed of decision making is much faster. Regulatory, we have more flexibility to invest into credit instruments like loan against shares, loan against real estate compared to bank. So that gives us an edge in terms of setting prices in the bond market. But at the end of the day, in the bond market, liquidity is always a fair weather friend. When there is enough money in the system, there is enough trading. But on the crunch day, the buyers disappear, spreads widen, and it's very difficult to sell your portfolio. Trading happens in higher rated assets, AAAs, AA plus, AA minus. But moment you go lower down the curve, A plus, A minus, BBB plus, there's hardly any trading, there's hardly any buyer. Now, market expects mutual funds to take the lead in development of corporate bond market. Banks, when they invest in corporate bond, will be able to repo it with the RBI, which will be the lender of the last resort. Who will be the lender of the last resort for mutual fund? I certainly don't want to experiment for the development of the market at the cost of my investors. I'm not going to invest in BBB minus rated paper or A minus rated paper or BBB plus rated paper if I'm not sure about the liquidity. On a bad day, I can pass the price risk to my consumer, but why should I take that risk? So like banks have a lender of last resort, I think RBI should provide that facility to mutual funds also. If you are investing in illiquid paper for the development of corporate bond market, at least for some time, till such time the market liquidity is there, give mutual funds similar access. The corporate repo bond market is there on paper, it has not developed like there is government securities repo market. So till such time we can manage this liquidity risk better, I think there will be slow development from the mutual fund side because we don't have access to lender of the last resort. The second thing is related to credit risk. Certainly there are instruments like loan against shares where we have dumped the shares to recover our money. Some of the companies where share prices have collapsed by 30, 40, 50% in a day, lenders have recovered their money by dumping shares. But on the other hand, if you have to use the judicial process to recover your immovable property charge, then that's going to take time. Check bouncing is supposedly a crime under Negotiable Instrument Act, but how many people get punished and in what time, that really causes a concern. So even on the credit side, mutual funds will be willing to take those credit risks where they are confident that they will be able to enforce security and recover their money. We are unlikely to go into that credit side where the security will not be enforceable or security will be enforced with a lot of delay. Now, unless until we can create a judicial mechanism where quick justice will be delivered, where we get confidence that in case the borrower defaults or borrower delays or borrower plays some tantrums, I will exercise my right, recover my security and take the money back. So we need to manage the credit risk and the liquidity risk as well for the overall development of the corporate bond market. Don't expect mutual fund to take the lead beyond its weight.
I think it's a fair point. I think while there is opportunities emerging, the need for risk management, need for the aspects like liquidity, other factors I think are critical for the debt side also to grow in the retail segment. Moving on, Nimish, picking your brains on, again, coming from an institution which has prided itself on technology at the forefront on the banking side. What has been your experience? Where do you think technology has a role in terms of accelerating the entire industry and its growth?
I think this mutual fund industry, in the terms of if we can have a simple, this one that all that hits the mutual fund industry should be hitting electronically. If we take that one basic step, that we will not accept paper of any sort. So someone needs to sit back or either the regulator or the industry itself, that we will not accept paper. This has to happen. If that happens, things will become automatic. A lot of things need to be done on that side. And my favorite point, which Nilesh and Leo have heard it many, many times, it begins with KYC. Right? We are not able to move forward unless we simplify this KYC thing. We'll never be able to do a paperless transaction and will remain in 1942. I feel the processes are stuck where we started. We need to go beyond the processes that we are. If somebody still in 2016, we are talking about filling up a form. Why is it that required? The bank, if you enter a bank, if you enter an HDFC bank or an Axis bank, and if they want to sell a mutual fund to me, the entire form has to be filled up. Why should that be done? He already has all the details that is filled up in my form. Right? We do it again. We do the KYC again where he has got all the details with the KYC. So unless we change our mindset on that, and where we'll need the government support as well as the regulator support, we need to sit together and resolve that. So unless we do, today for existing customers, everything is available. In fact, mobile has become the most preferred way of transacting with us. Mobile, the app that we have, I get more transaction by my app than that come on the laptop, right? So the mobile is a very, very, very important tool, and I think the mobile apps are doing a great job. But all that is possible once you become a customer. The industry challenge is into making new customers. So I go like a broken record on that thing. For existing customer, everything is available online. He does not have to do anything. He can buy everything. He can sell on his mutual fund, but on his phone. But that is once a folio is created. So once a folio is created, we have got the best of the systems possible. Everything happens on the mobile. I can sitting together right now on the stage. I redeem what in my liquid fund what I need tomorrow, right? So that is possible, but and getting a customer on is a difficult one. So first we need to resolve that, then we can discuss technology.
Fair enough. Last couple of questions before we throw open the floor for the audience. Consolidation, sir, if you look at it, the industry has become fairly consolidated. Even though there are 3 dozen or more than that players, you have the top 5, top 10 accounting for a lion's share. So it seems inevitable, but for an industry at the current stage where it is, especially from the penetration that we talked about earlier in terms of retail participation, having fewer players, is it good, or there are the challenges, probably there is a need for a lot more new players to come in?
I think in any industry, it's a good idea to have competition. I think that goes without saying. And there is never a situation where there's no room for new players, because industry structure evolves, opportunity evolves, disruption is always possible, new business models are always possible. So I think I would never subscribe to the view that there is a quota or a sense that there is a saturation point in an industry. That's never true. With changing customer behavior and technology and regulation, there's plenty of room for people to innovate and disrupt. But consolidation is ultimately a market-led phenomenon. It's not something you prescribe. It's neither good nor bad. And there are some forces which will push towards scale, and I think those are manifest everywhere. The forces which will push towards scale are usually economic, of course. And I think if you extrapolate trends elsewhere in the world, you can see that fees have come down across the world for asset managers. And they've come down, of course, they've come down to some extent for active products, but they've come down to a large extent because of the displacement of active with passive products. Again, that has happened for a variety of reasons. It's happened because the general track record of outperformance has been mixed. And it's happened because institutions fundamentally and trustees and decision makers just feel safer and better about making decisions which are less questionable, if you like. Because a lot of money that is invested today is fiduciary money. It's not really, in that sense, active money at all. And certainly that has driven fees down. And that is a very big concern. If you talk to the biggest asset managers globally, they will tell you that is their number one concern. And even asset managers that have $4 trillion, if you look at our asset management industry, it's $200 billion, and you have single asset managers of $1 trillion or $4 trillion, they are worried about this phenomenon and how they deal with it. I think, therefore, some amount of consolidation will happen as a result of economic pressures. At the same time, I'm certain that you will see people try and disrupt our model using technology. There's a lot of new technology available in how you manage money, not just how you distribute money. There are algorithms which will help you, in a sense, replace fund managers one day. And Nilesh and I have had a debate in the past about to what extent, you can displace versus complement. How many years will it take to truly displace, and where is it complementary? And of course, it's going to be a mixture of both. You will first see a complementary focus, but who knows what may happen? You're getting into a world of science fiction beyond that, but it may not be that far away. And these are all drivers ultimately of cost and scale. So I think we have to be conscious of that. I also happen to think one phenomenon in the Indian market which we will see is a shift towards more independent asset managers. Having seen an industry which was promoted almost entirely by corporates and banks for good reason, because they were the ones with franchise and brand and capital in the market, UTI being somewhat unique because of its history. I think there is a natural evolution that will happen, partly due to need for capital, monetization, and indeed just recognition that it is a better business model. Also, issues of corporate governance will arise eventually as we grow more systemically important. Today, we don't receive a lot of attention. Unlike banks, we can pretty much govern ourselves. Not that we do it badly, but we have less restrictions on how we're owned, how we're managed, how our boards are constructed. Banks are under tremendous regulatory scrutiny, by the way, on all these dimensions today, as you know. And it's a function of their size and perceived systemic significance. I hope we will be successful enough to be systemically significant soon. And at that point, I think you'll see a natural evolution in governance, ownership. And to that extent, there may be consolidation driven by those changes as you see a spin out happening from some of the structures that exist today. As banks spin out their subsidiaries, I do anticipate that in the next few years.
Fair point. So Nilesh, again, you are an industry veteran. You would have seen changes happening over the last 2 decades or more. So taking on from Mr. Puri, what are your thoughts? Would there be a further consolidation? Would you see some disruptor coming up with some new model, technology based or otherwise? What are your thoughts and what's your experience teaches you?
So globally, we have seen that there are far more number of asset managers, and they operate in listed segment, private segment. They operate in leverage investment segment, aka hedge fund. In India today, private equity has remained the domain of ultra-high net worth individual investors. Hedge funds haven't really come for local investors. Of course, they have come for foreign investors. So there will be evolution towards those asset managers over a period of time. They will be all about strategies and nimbleness rather than size. They'll probably charge much higher fees than what we are charging, but they'll probably provide far more return than what we will provide at that point of time. So the need for consolidation might be there, as Leo mentioned, on the listed space, purely from economics point of view or from governance point of view. But there will be far more opportunities on the private equity side, venture capital side, hedge fund side, long-short fund side. Those will be the niche products offering higher risk return and higher cost. Ours will become more standard run-of-the-mill products offering simple solutions. So industry will keep on evolving according to the consumer need.
Fair enough. So one last question before we throw open the floor for the audience. Again, we have eminent experts who are experts on the markets on both the equity and the debt side. So I think the audience would be keen to know your views on where do you think the interest rates are likely to move, the equity market. Any thoughts if you want to share? Starting with you.
See, we are where the market is positioned today. At ICICI Prudential, we strongly believe that markets are neither cheap nor they are very expensive. If you look at the ROEs of companies, if you look at the overall first the PE ratios, then they look On a prima facie, they look expensive. But where is our parameter of PE coming from? Our parameter of PE is coming from a certain interest rate. If the world is at a negative interest rate, what is high, what is low, one does not know. So from that point of view, markets, while we believe are slightly are look higher slightly today, but if you take the next 2-3 years scenario, look at where our corporates are placed. So there is from PE ratio point of view, you feel that the markets are slightly expensive. But if you look at the ROEs of company today, they are at an all-time low. So what are we saying is that the companies have invested money in their plant and machinery, but are not able to operate it at full capacity. So without further investment over the next 2 to 3 years, there is a possibility that a lot of companies in India will be able to sell more and utilize their capacities better. We believe there are lots of companies that will do that, and if that happens, the operating leverage will kick in, and the EPS over the next 3 years, you can see a healthy growth happening because the opportunity lies that companies are not operating today at full capacity. That's where the thing is. So I believe that overall money will keep on coming into India, and Indian mutual fund investments will also keep on increasing. If that is the scenario, it is very dangerous. It is now today more dangerous not to be in the equity markets than being in the equity markets, right? There is a risk of not being invested today. So with that, again, I come like a broken record, that I think the way to go forward is dynamic asset allocation products, so that the customers, where the market is placed today, where there is opportunity also, and where there is risk also, and volatility can come from outside the country, it is better to be in volatility management funds which can manage volatility better and make money out of volatility. That's the thought.
I think, so positive outlook, but leave the asset allocation to the fund manager to take that call. Nilesh, your thoughts on where do you directionally think the markets are, at both the equity and on the interest rate side?
As long as you don't ask the date, I can assure you that markets are going up.
That's well said.
In our opinion, in our culture, it has been said that when you take a dip in Triveni Sangam, you go for moksha or nirvana. So equity markets in India today have Triveni Sangam. The first is the liquidity. There are more number of buyers for Indian equity than sellers. The mutual funds, the life insurance company, the private insurance, the banks, the retail, the HNIs, the new pension scheme, the EPFO, the private provident fund trust, and the foreign institutional investors put together, they are buyers of equity far more than the potential supply of equity. So unless until we see a seller emerging who can meet that demand, liquidity will keep prices elevated, and which is why, as Nimesh mentioned, valuations are looking a little bit higher, but the correction which everyone is expecting is not happening. The second thing is sentiment. I mean, of course, liquidity is critical for prices to go up, but in a bearish sentiment, huge liquidity can move prices little. In a bullish sentiment, small liquidity can prices move by big margin. Now, sentiment seems to be improving. The GST bill passage, the RBI providing liquidity in banking system, the monsoon, the 7th pay commission. I mean, there are a fair amount of positive actions being undertaken in economy, which has improved sentiments of investors. The third and the final leg, obviously, is the fundamentals. And as Nimesh mentioned, we are today witnessing a cycle where return on equity is depressed, margins are at all-time high, all-time low. The corporate profitability as a percentage of GDP is more in the bottom 25 percentile rather than average. Even if we go up from bottom to average, there will be significant improvement in corporate profitability that will make current valuations cheaper, and hopefully that should result into, this combination of liquidity, sentiment, and fundamentals continuing to give return to the investors. At the same time, markets at this stage is like boxing ring. You may get 1 or 2 punches on your face, either because of global factors or because of some local factors. But as long as you stay in the ring, I'm sure you will win the match.
That's it. say your views.
I agree with everything that's been said, and I would remind you that we are, of course, a relative return industry in that sense. So we can only assure you that we will do better than the markets. We can't tell you with any certainty or any better than any of you know yourselves where the markets are going. And I think all the positives, of course, remain there. I do think the problem with global liquidity is it's a form of anesthesia. It sort of is in danger of disguising some of the underlying pain which the global economy is feeling. And as long as that is sort of there in your veins, the whole system tends to carry on because it must. What else do you do? The pain is dulled for the moment because there's enough anesthesia in your system, and that's liquidity. So the liquidity is deferring your ability to feel the pain until you figure out how you're really going to treat the root cause. And as of now, it's certainly my personal view that we have not yet understood how to treat the root cause of that pain. So the event risk overhang is very real. I would not wish to disguise the concern that I have on global event risk being a very real concern. And India being a sweet spot, having all the positives that Nilesh mentioned is, of course, partially insulated, but given the structure of our economy, given our relative dependence on ETF flows and FII flows, although mutual funds are manfully trying to fill that gap, we are not yet of an 800-pound gorilla yet. We maybe will be one day. There are genuine event risk phenomena that might impact. And therefore, I think ultimately, as Nimesh said, asset allocation, depending on your risk appetite, becomes very important. When you're faced with a situation where, on the one hand, you can't be out of the market, as Chuck Prince said, you can't leave the dance floor, because what are you going to do? The music is still playing, you'd better stay on the dance floor. But you have this worry that there is this sort of, there's this uncomfortable feeling that maybe this band is going to stop playing at some point. Where do you go? And I think you have to start reassessing where your situation is. What's your horizon? What is your real staying power in the markets? Do you have that staying power? Did you invest with a view that you were going to be there through cycles? Or did you invest with a view of a target return at a target date? And so these become situational discussions, but this is a very ripe time to be having those kinds of discussions because the balance between risk and reward is very even right now. You can't leave the dance floor, but the band may stop playing. So I suggest it's a great time to sit down with your advisors, your well-wishers, and to clarify yourself your own investing goals and consider portfolio reallocation. And there's no one answer to what that is, but it's certainly the right time to be doing that today.
I think fairly balanced view. I think boxing ring, dance floor. I think all of us really now understand what they mean by mutual funds are subject to market risk. So I think we need to be very carefully looking at before we invest. I think with that, I would want to stop and throw open the floor for the audience for any questions. Before you ask any question, please state your name, organization that you represent, and the panelists that you want to direct that question. 3 questions. Oh, okay. Sure. Should I wait for the floor? Okay, sure. I think I'll start off. I think there are some questions from Twitter. What can AMCs do to dispel the investor perception that mutual funds are black boxes?
So let me answer that in a very, very stern way. In Mahabharata, we had a character called Gandhari who wrapped her eyes for reasons which all of you know. Now that was Dwapar Yuga, and that's why Gandhari was there. Today we don't have Gandharis, but we have many Dhritarashtra's. And a mutual fund which is so transparent, where you can see the expense ratios, where you can see portfolios on a monthly basis, where you can see performance without photoshopping, they find it black box. But the same investor buying an 18-carat jewelry at 24-carat price feels comfortable. He doesn't mind investing in real estate where the builder can take him for a ride wherever and whenever he wants. Now, I want to ask that gentleman, what is his definition of black box? What does he consider gold? What does he consider real estate? So my request to that Dhritarashtra will be, please remove your blindfoldedness. Don't be like a Gandhari.
Fair enough. I think there are specific questions about taxation. Somebody wants to know, how are they taxed? Nimesh, you want to take that? What is the taxation for retail investor on the mutual funds?
If it is an equity investment on a 1 year basis, after 1 year, if you redeem your investment, you don't get taxed on it at all. So whatever the capital gains that you get, you don't get taxed at all. If you get dividend, you don't get tax on the dividend also. So according to me, it is one of the very investor-friendly taxation that you can get. You can't have it better. On debt, if you should remain invested for 3 years, then you can get the same similar benefit. Of course, indexation and all has to be taken care of.
I think there is one more query on the infra sector. How is it performing? What are the prospects for the infra sector?
The infra sector has been in a cycle, clearly, obviously. So from being a very hot property maybe 5-6 years ago, and
8 years.
7-8 years ago, yeah, it's actually been in a slump probably for the last 3 or 4 years. And it is a function of all the stalled projects and the regulatory mishaps that have occurred in key sectors, whether power and telecom, and which are obviously very highly leveraged sectors. At this point, it does look like that cycle should start to turn. I think it will turn both as a result of government policy and some recovery of animal spirits and the capital investment that goes with that. So I would say it's too early to say it's a sunrise industry, but I think it's emerging from the sunset that much. We're in twilight, I would say at this point it's twilight. I think the dawn is not too far away for the infrastructure sector, given my belief that we really do have much more clarity today in terms of prioritization of key projects, key sectors, and I think we will have a better policy framework and a better and less corrupt regulatory regime in place for most sectors. So I'm actually growing moderately optimistic about the outlook for the infra sector at this point.
That is what I was talking about, concept selling. Concept selling is what has not worked in 8 years. By law of averages, if you believe that the industry is at a place where it can do well. So that is the understanding required by the middleman to recommend a industry product when it has not worked in the past. If the AMC is good, if the fund manager is good, if he understands both the things, then the industry is good, then he can recommend at that point of time.
I think right knowledge and the conviction is very critical for the. Any questions from the floor? I think there's a mic there.
Yeah, the fund.
If you can introduce yourself.
Yeah, I'm Dinesh Rana from SJ Investment. Now, mutual funds are transparent, but the corporate disclosures are not so far transparent. So, you have, people say it's abroad it's a perfect market. Here it's not so perfect market. Here, active funds do well. Passive funds do not do so well. And, incident like Satyam also happens here. So what type of disclosure you fund managers would like to have from corporates? So it can be a very transparent thing. So because, information travels slowly from the corporate disclosure first to the selected people, fund managers, and then to the market. So what type of disclosures you would like to have? More disclosure from the corporates.
Dinesh bhai, for every Satyam which we have, there is Enron over there. Now, we all want to blame ourselves saying that we have Satyam. But what about their Enron?
But I think that's one way of responding. But I would also say that I think the sources of this governance lapses in India are quite well understood now, and a lot of action is being taken, both by regulators, legislators, and of course by us as an industry. And there have been 2 or 3 areas which have been the themes there. Related party transactions has been one. If you look back over the years, many of these so-called non-transparent or problematic issues have arisen because of poor disclosure around related party issues, including, the famous Satyam and so on. I think that has been largely addressed. You can see how much effort has been put in through the Companies Act, through regulation, through listing requirements and so on, through the way boards are working. All of this has been very positive. In fact, the second sort of area has been around disclosure of financial information, which is again, consistent standards of reporting, your revenue and cost accounting policies and so on. And you can see the amount of standardization that has come in India today, where you can finally now compare accounts. Accounting standards have gone up. And the games of deferring cost, advancing revenue, and all of these things which used to happen is increasingly, I think, rare today. So these to me would be very concrete examples I would give where you should take heart as an investor that the reforms and steps taken in corporate governance have been quite significant. As Nilesh is implying, no country is perfect, but I don't think we are any longer at the bottom of the class. I think India has moved up to a point where we are certainly in the top half, I would say, even at a global level, and among emerging markets, you only have to listen to what global investors today say about India. They actually highlight that corporate governance is one of the features of India today in 2016, which gives them relative comfort compared to other emerging markets. So it's not perfect, but a lot of work is happening, and I think you should feel more assured than you were maybe 4 or 5 years back.
Another way of looking at it is because we have got cyclical corporate governance, that is why we require fund managers who can take the right call for the investment.
Mics here, please.
My name is Aishwarya Mittal. My question is more on the as an investor, okay. See, there is the awareness expenses are there in the mutual fund, but there is no innovations kind of thing. See, there is no mutual fund card like a ATM card. Why not you have some, the ID card of your mutual fund per se? Because wherever I approach for any query, generally he start about the PAN card, what is your PAN number and this and that. Might be on going ahead, you have some, mutual fund machines where instantly I can get, money out of the system. Might be you can go with the tie-up with the banks and all these things. Because every day you publish some NAV and all these things. So definitely you have a certain amount that it may be, withdrawable from as an investor. So going ahead, it will be give very good liquidity in the hand of the investor. And the second, the unit I can't use as a collateral or for there is no OD and all these things. Certainly you might be as an industry just talk that I have certain the collectible security going ahead. So I have certain comfort in comparison to the FD. So instantly I can pledge and just have whatever the haircut you can keep. That is the second thing. But I want certain liquidity instantly, so I can keep replacing my FDs for the futures.
I agree with you. We should have that product. We'll have that product. I think it's in the development stage. We'll give that product can be done. And pledge anyway. The security against that security is available even today. You can go to any of the banks, and the banks will take that as security and can lend against it.
Hi, I'm Nitin from HSBC. My question is basically on the disruption piece. Do you see any major disruption led by a regulation change or maybe by technology to impact the distribution community? Basically, I'm referring to something which has happened in UK, where in the regulation, because of some changes in the regulation, the entire IFA category was knocked off. So do you see some major disruptions coming forward?
Well, I think that debate is already live. It's not a matter of whether it might, or I think there's already a live regulatory process to essentially explore how you can evolve the distribution model in India. And I think all of us should be engaged in that because it's a very important debate. I don't think it has reached any definite conclusion yet, but I think many of us in the room are aware that post what happened in the UK, and for those who are not aware of what happened, in a nutshell, essentially the move was away from a commission-led, embedded product commission-led structure to one where you unbundle fees for advice from the product, so that essentially advice has to be paid for separately, in a sense, in a way that the customer acknowledges. Now, that's a model which many policymakers around the world have been thinking about, because fundamentally, in their mind, from a consumer protection perspective, they think that is fairer. Now, that model assumes, of course, that you've reached a certain stage of evolution, that sophistication, ticket sizes, and so on are such that people can make that choice and that people are comfortable paying separately for advice as opposed to buying a product. And I think where the room for debate lies is India indeed at that point, or will India be better served by a suitability model? That as long as you prevent mis-selling, and as long as you cap total fees, which we do in India, total expense ratios, have we not achieved the objective of protecting the customer while at the same time ensuring that growth and participation occurs? Because, as I think was said earlier, the cost of not participating in wealth creation in India is also very high. And policymakers have to weigh that. And that's what certainly a view that AMFI is taking, is that we must ask ourselves, it's easy to say no, but somebody has to be responsible for the fact that if participation doesn't occur, and if you actually slow down that pace, then you would have deprived people of an opportunity to benefit from a very healthy product. We're not selling tobacco or alcohol here. I mean, we're selling fundamentally something that I think has been said is an important, essential part of financial well-being. So there is, I think, my own view, my personal view is we will find a balance. I don't expect us to go in the direction that the UK has gone. But I would encourage everybody to participate in that debate because it can't happen in a vacuum. I think people's voices need to be heard on this issue in a constructive fashion, in an intelligent fashion. And certainly as AMFI and many of us in the mutual fund industry, we are making sure that this view is carefully balanced so that we don't end up throwing the baby out with the bathwater. At this point, that's all that we can say.
I think probably one last question. There was one gentleman standing there for quite some time. Yeah.
Hello.
Yeah.
My name is Siddharth Shroff. I am an IFA. Now, can you highlight on the cash distribution commissions disclosure, which is going to happen from October 1st to the mutual fund industry? And how is going to impact the smaller IFAs and the distribution community?
Ramesh, you want to take that?
I think I'll get transferred. All these questions are going to come to
All
me.
the tough questions
all the,
to Leo.
There's I guess it's a, no, I think I just say a couple of things. One, again, perhaps this is related to the earlier question, that if you believe that as part of investor protection and in order to give investors the comfort that this is a well-regulated product, as a regulator, you should be doing everything to give them as much information as they can so that they make informed decisions. That is the view the regulator has taken. And disclosure then becomes a very important part of the regulator's thinking as to what information. So essentially the regulator's argument is, why not give the investor all the information he needs? You're selling a good product in any case. They should be able to understand that this is in fact a fairly attractively priced product. What's the problem with actually sharing this information with the investor? Now, that in a sense, some of this is water under the bridge because the debate has sort of occurred. I would at this point say probably not something to overreact to. If you look at disclosures that have occurred over the last few years, of course we had the manufacturer side, we had disclosure of compensation and salaries and so on, again as a part of a global trend. It was really apart from 2 or 3 days of excitement for the media and a few of the press people, perhaps some of whom are here, I don't think anybody can remember what it was all about. There was a tremendous build-up, a tremendous amount of anxiety, a lot of WhatsApp messages and social media angst being expressed and so on. And frankly, most of us would not remember, really what the consequence of that was, because it didn't matter as much as people thought it would to either investors or to ourselves. Similarly, I think the notion that we already disclosed TERs. So in a sense, a lot of disclosure is there. The investor already knows the maximum expense ratio that is being paid to him if he cares. For those who now want to also know within that TER what percentage is commission, that information is available. Two things might happen. Yes, it's possible there may be some additional pressure, in a sense, on the Distribution Advisory Committee to respond to questions, queries, and so on as to their value add. I think the right way to do that is to preempt this in a way. And I suggested this some months ago as well when I met a group of distributors. I said, we can't tell where this will go, but I strongly recommend that you take this bull by the horns and engage your investors proactively. Those who have sophisticated investors have already done this. They've already talked to their clients about how the industry works, what the structures are, what the value add is, what their own economics are. That commission is not, of course, the earning the distributor has. It's in fact the total fees he earns, from which a whole variety of other costs have to be extracted and so on. So at this stage, the only practical advice, again, is to say, proactively engage your clients on the value proposition you offer. Experience elsewhere in the world suggests they will not overreact, that they will actually continue to value the services that they are getting, which are typically very important for them. And I think within a few weeks or months, the excitement will pass. And I think it will be another non-event in the history of the development of Indian mutual funds.
In the interest of time, I'd like to call this session to a close. Thank you, gentlemen. I think it was wonderful talking to you. Thank you very much.
Big thank you to all our panelists and to our moderator. As a token of our appreciation for a very insightful and incisive panel discussion, I'd like to call on the dais Mr. Aman Kanjlia, Director, Conferences, Time Conferences Limited, to present each of our panelists with a memento as a token of our appreciation. Thank you, Mr. Nimesh Shah, Mr. Nilesh Shah, Mr. Nagarajan Narasimhan for moderating the panel, and Mr. Leo Puri.